In this video, I'm going to cover the next two sections in Chapter 13 on stock prices and investment opportunities, and then multi-stage growth models. Let's dive right into the first one here, stock prices and investment opportunities. What is this about? We just did the Gordon growth model, or the constant growth dividend model, and I explained that it was in a lot of ways overly simplistic. It only applies to what kind of companies? It applies to companies that have very stable dividends that you can estimate their growth all the way out to infinity. The model goes to infinity. And then I mentioned some things like, well, to use that model, the market cap rate must be greater than the growth rate. We saw that it had some other properties. In this section, what are we going to do? We're going to try to set up a little model which is going to give us a little more intuition into the drivers of growth in the Gordon growth model. And we're going to do that in a couple of ways. So the first thing we're going to do is we're going to look at where does that growth come from? And can I maybe have a little model of growth and also relate it to parameters that I could actually look up for a company? Okay, so here's our model. And our model is the following. So every year a company has earnings, at least we hope. If a company does not have earnings, we should not be using this model in the first place. So that's a safe assumption. And if you think about it, when the company has earnings, it can essentially do two things with the earnings. Okay, it can either pay them out as dividends, that is to us as the shareholders, we get those directly as dividends, or it could hold on to those earnings and it can plow them back into the company. Another term for that is it can retain those earnings. And when it retains earnings, usually it should do that because it has good investment opportunities and that can fuel growth. So that's going to be our basic model here. So let's take a look at our model. And we're going to say, hey, things go back to earnings. I'm going to call earnings E. And what can a company do with those earnings? Well, let's focus down here. I'm going to call this parameter B, and B is going to be the plowback ratio or the earnings retention ratio. What do we mean by that? It's the fraction of earnings that the company holds on to. Okay, so if they're holding on to B, maybe B is 20%, then how much are they paying out as dividends? They're paying out 1 minus B as dividends. And so this would be called up here, 1 minus B would be the dividend payout. Okay, so dividend payout means some fraction of the earnings are being used to pay out dividends. So that means, remember, our Gordon growth model was in terms of dividends. Now we can say, hey, those dividends, those should come from what? Earnings, and they should be related to the plowback ratio. In fact, 1 minus the plowback ratio times earnings, that should be a formula for those dividends. Okay, so this is going to allow us to replace the D in the Gordon growth model with 1 minus B times E. Okay, again, B is the plowback, or the earnings retention ratio. And then on the other side, we have earnings. If a company is plowing those earnings back into the company or retaining those earnings, presumably it holds on to those earnings. Why? Because it wants to invest them. And when it invests, we assume that it earns the company's return on equity, ROE, return on equity. That's the rate of return that the company is getting on their investments. If that's the case, that should fuel growth. And that gives us, in fact, a little model for the growth rate, okay, which we also saw showing up in the Gordon growth model. So that would say that the growth rate is B is plowback times return on equity, okay? And you can justify this carefully. I did this down at the bottom, but it basically gives us a simple model for two of the parameters that we saw in the Gordon growth model, the dividend and the growth, but it puts it in terms of things that now we can look up. And I want to show you quickly where you can look these up. So what are some of the things that we talked about here? I'm going to jump over to FinViz, and I've got NVIDIA pulled up. Now you can take any company, and I'm going to scroll down here, and let's look at some of the things that we talked about. The first one I'm going to focus on here is payout. Okay, so right here you see payout. This is the dividend payout ratio. Now our model is in terms of what? Plowback ratio, or earnings retention ratio. But what is not retained by the company is paid out. So they show you that here. So this would be 1 minus B in our model. Normally this is the one that a financial website will show you. Okay, so to get B, we would take 1 minus this. So note that the payout ratio is 1 minus B in our model. So in this case, NVIDIA is paying out a very small fraction, a very small percent of their earnings, just a little over 1%. That means what? They're retaining about 99% of their earnings. Okay, so their earnings retention ratio would be very, very high, a little under 99%. So that's the first thing we can look up right there. The other thing that we looked at was we said, hey, when they retain those earnings, they're going to invest them, and they're going to invest them at their return on equity. This is what they are making on their investments. So I look at this right up here, and I have ROE. And of course, NVIDIA is making a ton of money. Their investments are just super profitable. So they're making over 100% their return on equity. So that means they should be able to grow a lot. Our model would say, take how much they are retaining, and if they are plugging that in and investing that at their return on equity, then if I multiply those two together, not the payout, but 1 minus the payout, right? That was our, that's what we called B, earnings retention ratio, multiplied by ROE, that is a model for the growth. So what we're doing here is we're trying to take the Gordon growth model, and we're looking at some of the parameters, the dividend amount, the growth rate, and we're trying to relate them to real things about the company, like what the company is actually earning, related to how much they retain versus how much they pay out. That's the idea here. Okay, let's see where that leads us. So these are our basic models right here. So what do I have right here? I've got a model for the dividend amount. I've got a model now for the growth amount, and I can just go back to the Gordon growth model, and I can, in fact, just plug those right in. So let's see what happens when we do that. So now I can do valuation. Remember, we called it intrinsic value, but in terms of earnings, plowback ratio, return on equity. And here's what it leads to. So I'm going to write the Gordon growth model in terms of earnings. This was our basic Gordon growth model, but we just said the following. We said, hey, the dividend, that should be earnings multiplied by 1 minus the earnings retention ratio, or 1 minus the plowback ratio, B. Okay, so I was able to do that. And then we said, hey, the growth here, what is that? The growth, we said our model was that should be plowback times a company's return on equity. So what is this? Now I have a value, the intrinsic value that I've calculated of the company in terms of things that I can potentially look up, right, on a financial website. Plowback ratios, return on equity. Okay, so this is kind of a nice model. Why is this a nice model? It gives us more intuition into valuation. Now, this model is complicated enough that you can't just eyeball it and immediately have the intuition jump out at you. So I'm going to tell you what the key intuition is that comes out of this model. And you can verify this, put it in a spreadsheet, play around with some numbers, and here is the following intuition. And it turns out that there's an interplay between return on equity and the market cap rate. Let me remind you of what those were, and then I think this intuition makes sense. So return on equity is what? That's what the company actually earns on its investments, at least its equity investments, right? The ones that it's paying for from equity. So think of the return on equity as this is what the company is actually earning on its investments. What is K, the market cap rate? This is what CAPM says is a reasonable rate of return to earn on its investments, okay? And in problems, they often say the market cap rate. This is what the market expects or what investors expect for the company to make. So this is what investors expect. This is what it's actually making. And so if you play around with this model, the following pops out. If return on equity is higher than the market cap rate, what does that mean? This company is making more than what the market or the investors expect, okay, on their investments. Is that a good company? Yeah, that's a great company. It's making more than sort of what I would say, CAPM says you should make, 20%, and your return on equity is 25. Wow, you are beating CAPM. Essentially, it has a positive alpha. That is a good company. They're making great investments. They're doing a good job. And so in this case, if the return on equity is greater than K, then what will happen in this model? Reinvestment adds value. What do I mean by reinvestment? Reinvestment corresponds to B. That is the amount of money that they are retaining, that they're holding on to. That will cause their price or their value to go up. Again, that makes sense because they can invest in things at a higher rate of return than what CAPM predicts. Think of CAPM as K, return on equity is what they actually get. I want them to hold on to that money and make those good investments. So the more that they hold on to money, the more that they retain, the more that they plow back, the more valuable they should be, okay? And the price will increase. That's the key intuition from this model. Very, very important. So make sure that you understand it. The flip side of this is if you have a company and their return on equity is less than what the market expects, is less than the market cap rate, they're doing a bad job. Basically, they're making investments that are underperforming what CAPM says or what investors expect. And of course, they should be punished for doing that, right? So reinvestment is actually destroying value. They're holding on to money. They're investing it at a lower rate of return than what CAPM says they should be able to get or what the market cap rate is. And their price is going to decrease because of that. All right, so that's the key intuition here. So this is a nice model. And it also helps, sort of what I take away from this model is that if I'm looking at a stock, now I've showed you on FinViz, and you can look, and there are a ton of things about a stock that you can look at. In my opinion, a lot of it is information overload. What is the good of a model like this? Now, overly simplistic model, however, what it helps me do is to focus on certain things that are important. So what's important about a stock? For example, its return on equity is very important. I want to make sure that that company in its investments is actually making a good rate of return. If it's not, then it might not be one that I want to invest in. If it's making a bad return or a low rate of return or even losing money and they are retaining a lot of earnings, okay, then they're doing a really bad job. So for me, it helps me to focus on what are some of the numbers that I should be looking at when I'm looking at a company. And this simple model here points me to things like the plowback ratio, or we saw it on FinViz, we saw the dividend payout ratio, which is this one. So take 1 minus the dividend payout ratio. That is the plowback ratio. B here is the plowback ratio, and return on equity. And those are the things that you should focus on and that help determine value in a company. Okay, with that said, let's move on. We can do a little bit further analysis with this, but this here is really the key intuition. All right, what we can do here is we see this model, right? And what's very important in the Gordon growth model is the growth rate, right? And we saw that we have a little model for it here, and that's very important in terms of determining value. So it turns out we can take the total intrinsic value and we can break it down into part of it is due to what? Sort of the current earnings power of a company. And then another part we will associate with the growth, the future growth. And that's a nice way to break down the value of a company. So let's see how that works. First, we're going to calculate the price under a no growth assumption. I'm going to call that P sub NG, NG standing for no growth. That is a very, very simple formula. So note, when there is no reinvestment, what is that? Plowback ratio is 0. That means the company is not holding on to any earnings. They're taking all their earnings and paying them out as dividends. Okay, then all earnings are paid out as dividends and there's no growth. Basically, B is 0 here, B is 0 here. So if you go into this model, what do you get? The price is simply earnings divided by the market cap rate. Okay, so you get a super simple formula. So how do you think about this formula? If this company could not grow any further, it was just stuck at their current earnings, how much would they be worth? Well, they would be worth their earnings divided by the market cap rate. Okay, so for a lot of companies, as long as you think they can hold their current value, even if they couldn't grow anymore, they should be worth this, and this is sort of a lower bound. Now that we have this, then we can actually calculate how much their growth is worth. Let's take a look at that. So this we call the present value of growth opportunities. So now we're looking at what is the value of their ability to grow, okay? And what is this? The present value of growth opportunities is the difference between the intrinsic value, the value of equity, right, and its value under the no growth assumption. Why is that? Because the value of equity, this has the growth built in the model. And then we calculated if they couldn't grow any at all, they should be worth the value under their no growth assumption. So the difference of those two is the value that we attribute to their ability to grow. That is the present value of growth opportunities, and we often will abbreviate this as PVGO or PVGO. What is that? You take the price, the normal price, you subtract off the price under a no growth assumption, and what you're left with is the value of their growth. Okay, so this is the formula that I focus on here. If I want to write out both of these in terms of their formulas, then you can write it out in the long way. But normally to calculate this, you calculate the intrinsic value, you calculate the price under a no growth assumption, you subtract them, and that gives you the present value of growth opportunities. So this is nice because you can take a company, right, and you can ask, well, maybe its current price is $100. How much of that $100 is based on their ability to grow in the future? How much am I paying for their future ability to grow versus how much am I paying for their current earnings power? So the ability to grow in the future, that is the PVGO value. Let's run through these calculations to make sure we understand this. All right, the market capitalization rate for Admiral Motors Company is 8%. Market cap rate, what variable was that? That's our K. Its expected ROE is 10%. So now they're telling us parameters like return on equity. And its expected earnings per share is $5. What did we call that? That was our earnings at time one over the next year. If the firm's plowback ratio is 60%, what variable was the plowback ratio? That was B. Number one, calculate under our simple model the growth rate that we would assume for this company. So go ahead and try that yourself. I'm going to reveal the answer here. So the growth rate was simply this. It was the plowback ratio multiplied by return on equity. Plowback here was 60%, return on equity was 10%, or a 6% growth rate. So under our model, we would say, hey, looks to me like this company should be able to grow at about 6%. Okay, so that's the first part. The next part, calculate the price of this company. And price here, what do we mean? Intrinsic value. Okay, so let's go to that formula. That formula was the following. Remember, we derived it from the Gordon growth model, but now we're using these different parameters. We're using things like the plowback ratio, earnings, and return on equity. So let's jump over to this model and go back a slide or two. And this was the formula right here. And so we're just going to plug in. It was 1 minus the plowback. Remember, plowback was 0.6, so 1 minus that is 0.4. Earnings, $5 per share. Market cap rate right up here, 8% minus, and then this is B times ROE. That's the growth rate. We calculated that right up here at 6%. I plug in, and this company is worth $100. Okay, so I calculate that. I say, okay, this company looks to me like it should be worth, its intrinsic value is $100. Final thing we can do, how much of this $100 can I attribute to its ability to grow in the future? So that is present value of growth opportunities. Go ahead and try to calculate that. I'm going to reveal the answer. You might pause and see if you can do it, and then unpause and see if you get the same answer as me. So first, how do we calculate present value of growth opportunities? Well, the first thing we do is we actually calculate the present value under a no growth assumption. And that is what I called P sub NG, NG meaning no growth. And that was a really simple formula. I just take the earnings, whatever it can earn right now, and I divide it by the market cap rate. It's earning $5 per share right now. The market cap rate is 8%. 5 divided by 8%, that's 62.5. So this says, hey, even if this company could not grow at all in the future, there were no more growth, I'd still think its value should be $62.50. Okay? So what is the present value of growth opportunities then? Well, I look at it and I say, hey, it's actually worth $100 right now. That is the current value, 100. If it couldn't grow, it would be worth $62.50. So I take that difference, $37.50. That must be attributed to its ability to grow. That's its present value of its growth opportunities. So if you do this analysis, you can see how much am I paying for sort of the current earnings. That's the price under the no growth assumption. How much am I paying for those future growth opportunities? That's a PVGO. That's the present value of growth opportunities. If you go and actually look at companies in the market and try to do this analysis, it can be a little bit tricky because, like I said, our models here are very stylized and they only apply to certain companies. But it'll give you a sense of how much am I paying for growth in this company, right? What is the value of its future growth? And that is the PV-GO. Okay, so that was taking our simple model, right, and relating it to some parameters, things like return on equity, plowback ratio, and getting a little bit of insight into that, and that was pretty nice because we can calculate things like present value of growth opportunities. However, it's still a very simplistic model. Now, to go further in this area, what would you do? You would make your models much more complicated. I'm going to show you very briefly what that looks like, but I'm not going to dive into any of the details. So this is just to give you a hint of where this subject goes in the future, and that's multi-stage growth models. Let's take a look at that. So if I wanted to take these ideas and make them more realistic, what would I have to do? So our model used a single growth rate out to infinity. And what did I say? That's only appropriate for a firm that's well established in a stable, mature industry, right? It pays a dividend. I can estimate that growth rate of that dividend. It's going to be very consistent. It would have to be that situation to apply the models that we've just done. What do I do if we're not in that situation? So for companies in a newer industry, what do we use? We use what we call a multi-stage growth model, and that might be more appropriate. What is that? For example, growth rates might be very high for companies in a new, fast-growing industry. Maybe there's a company in AI right now. It's still pretty new, so I would expect it to grow very rapidly, right? However, eventually, these industries will mature and growth will slow down, okay? So that means right now, I should be using a high growth rate, but at some point in the future, these industries are going to slow down in their growth, they're going to mature, and maybe I could eventually go to a Gordon growth model. But that's the basic idea. So we'd like to model a model that allows for various growth rates to match the different life stages of a company and its industry. And what are those? We mentioned those, I believe, in chapter 12. Initially, you're going to see high growth, and then you're going to see a phase where it begins to slow down. You often see a lot of consolidations, and then you eventually come to a stable, mature industry. So we want to model these growth rates to match this industry life cycle. That would look something like this. If I look at here's my cash flow stream, here's time again, and I'm starting back here at 0, and I might try to set up a model that looks like this. Initially, the growth rate, I'm going to call that G1, is very high because this industry is growing very, very fast. But I assume that after some amount of time, I don't know, maybe it's 10 years, it's going to begin to slow down, and it's going to go into its next phase of growth. And maybe that one is consolidation. It's still going to be growing pretty fast, but not as fast as before, so I'd use a different growth rate. And then after some amount of time, I don't know, maybe out 20 years, eventually I assume every industry is going to mature. When it's mature, it's going to be much more stable. And then maybe the Gordon growth model is appropriate, okay? But that's only after 20 years. So I'm going to have a model here where I have very rapid growth rate, and then it slows down, and then finally I'm mature. Now, the problem with this is that I don't get a simple model now. So I need to basically set up these models on a spreadsheet, and I need to do my present value on a spreadsheet, and that gets complicated. But I wanted to show you the idea right here. So we can use a spreadsheet model to compute the present value, and again, that's going to look much more complicated. You're going to set it up on a spreadsheet, and you're going to try to estimate those growth rates and assume that eventually they're going to slow down over time. Okay, so I just wanted to show you that, as if you are interested in this kind of modeling, this is sort of the direction that it goes in, and you would want to take a further course in that area.